If you've been holding silver over the past few weeks, you've probably noticed the volume getting louder. Headlines talking about the breakout of a generation, thumbnails with price targets that start with a 4 or a 5, and a growing sense that something big has to happen any day now. And to be fair, the next few days do matter more than usual, but not for all the reasons you're seeing pushed around online. What I want to do today is slow this down, remove the emotion, and walk through what the data is actually telling us right now. No hype, no doom, no promises. Just probabilities, context, and a clear framework for how I'm handling silver at these levels. If you're new here, welcome to Financial Briefing. This channel exists specifically to cut through the noise and focus on what matters, especially when markets start getting loud. Before we talk about what could happen next, I want to start with accountability because analysis without a track record is just opinion. Back in early March, when silver was trading around $26, I said the odds favored a grind higher rather than an immediate breakout, with a likely move toward the high 20s before any real test of resistance. That played out. We pushed to just under 29 before momentum stalled. In late April, as silver spiked above 31, I cautioned that momentum indicators were stretched and that chasing strength carried elevated risk, even though the broader trend was constructive. Within 2 weeks, we saw a pullback to the high 29s before stabilizing. And in May, when some channels were calling for an imminent collapse back to the low 20s, I said the probability of a deep breakdown was low as long as silver held above the 2850 area. We never broke it. That doesn't make me right all the time. It just means I'm committed to following the same process, whether the outcome flatters it or not. So let's get into the data that actually matters right now, starting with price itself. As of today, spot silver is trading around $32 and change, depending on the hour. That alone sounds dramatic if you anchor to where silver spent most of the last decade. But context matters. Adjusted for inflation, silver traded well above $40 in both 1980 and 2011. Even unadjusted, $32 is not historically extreme. It is elevated relative to the last 5 years, but not relative to longer-term cycles. What this means is that silver is expensive compared to its recent range, but not expensive compared to its historical potential. What it does not mean is that silver is guaranteed to continue higher simply because it hasn't reached the old highs yet. Markets don't move because of nostalgia. They move because of marginal buyers and sellers. The second data point is volatility. Over the past 10 trading sessions, silver's average true range has expanded to roughly $1 per day. That's a meaningful increase from the 50 to 60 cent daily range we saw earlier this year. Rising volatility often precedes directional moves, but it does not tell you which direction that move will be. Historically, periods of expanding volatility in silver have resolved higher about 55% of the time and lower about 45% of the time, with the remainder resulting in choppy consolidation. So volatility is a condition, not a conclusion. It means the market is deciding, not that it has decided. The third data point is volume and open interest. Futures volume has increased alongside price, and open interest has risen modestly, not explosively. That's important. When you see price rising with stable or gradually increasing open interest, it suggests new positions are being added, not just shorts getting squeezed out. What that means is that this move has participation behind it. And what it doesn't mean is that all of that participation is smart money or long-term money. Some of it is speculative, some of it is hedging, and some of it is short-term momentum chasing. Now, one more thing that is getting a lot of attention is the idea that the next few days change everything. There's a kernel of truth there, but it's being overstated. Silver is approaching a technically significant zone between $33 and $34. This area capped price multiple times in 2011 and again briefly in 2020. If silver can close decisively above that zone on strong volume, it changes the medium-term picture. If it can't, the market doesn't collapse, but expectations will need to reset. That's the real inflection point, not a magical overnight revaluation of the entire monetary system. So when you hear someone say, if silver breaks 35, it's gone, understand what they're really saying is that above that level, there is less visible resistance on the chart. That increases optionality, not certainty. As we move forward, the key question isn't whether silver is bullish or bearish in some absolute sense. The question is whether the current setup justifies adding risk here, reducing it, or doing nothing at all. And that answer depends on probabilities, not narratives. Over the past quarter, global silver demand estimates have increased modestly, not exponentially. Industrial demand, particularly from solar and electronics, continues to grow at a steady pace of roughly 3 to 5% year over year. That's healthy. It's supportive. But it's not a sudden shock to the system. Retail coin and bar demand has picked up in certain regions, especially Asia, but it's uneven. In North America, retail demand is higher than last year, but still below the peaks we saw during the 2020 and 2021 panic buying phases. Historically, the kind of demand surge that truly forces silver higher very quickly looks different. In 2011, for example, retail demand spiked simultaneously with ETF inflows and aggressive futures positioning. Right now, we're seeing improvement, not frenzy. That matters. What this means is that physical demand is acting as a floor, not a rocket engine. It provides support on dips, but it doesn't by itself guarantee an upside breakout in the next few days. What it doesn't mean is that silver is running out, or that the system is about to break because mints are temporarily backlogged. Backlogs happen regularly during periods of elevated interest. They are a signal of stress at the margin, not proof of imminent repricing. The next data point is relative strength versus gold. The gold to silver ratio has compressed from around 85 earlier this year to roughly 75 now. That's a meaningful move. Historically, when the ratio compresses rapidly, it means silver is outperforming gold, often during risk-on phases or when inflation expectations are rising. But context matters again. In 2011, that ratio fell into the low 30s. In 1980, it briefly touched the teens. Compared to those periods, 75 is still elevated. So yes, silver is gaining on gold, but no, it has not entered a historically extreme outperformance phase. What this means is that silver has momentum relative to gold, which tends to attract traders looking for leverage to precious metals moves. What it doesn't mean is that silver has to continue outperforming indefinitely. Ratio compression often pauses or reverses during consolidation phases. Now let's talk about time, because this is where expectations often get misaligned. Markets don't move on your schedule or mine. When silver approaches a major resistance zone, it can resolve in days, or it can spend weeks chopping sideways, wearing out both bulls and bears. Over the last 20 years, when silver approached a comparable technical level after a strong run, the most common outcome was consolidation lasting between 3 and 8 weeks. Fast breakouts did happen, but they were the minority. That's uncomfortable, because it doesn't generate exciting content, but it's reality. So, with that foundation, let's lay out the bullish case clearly and fairly. The first bullish argument is technical. Silver is above its rising 50-day and 200-day moving averages, with both trending upward. Momentum indicators are elevated, but not yet at the kind of extremes that historically mark major tops. If price can absorb selling pressure near 33 to 34 without a sharp rejection, the path of least resistance opens higher. The second bullish point is macro alignment. Inflation expectations, while off their peaks, remain sticky. Real rates have stopped rising aggressively. That combination has historically been supportive for precious metals, especially silver, which tends to lag and then catch up in these environments. The third bullish factor is positioning. While speculative longs have increased, they are not yet at levels that historically precede sharp liquidations. There is still room for additional capital to enter without the trade becoming excessively crowded. And the fourth bullish argument is psychological. Silver has been ignored for a long time. When assets break out of long consolidations, they often overshoot what fundamentals alone would justify, simply because positioning was light for so long. Put together, the bullish scenario is plausible. In that scenario, silver breaks and holds above the $34 zone, pulls in momentum buyers, and pushes toward the high 30s over the coming months. I assign that outcome roughly a 25% probability. Not impossible, not dominant, but real. Now we need to be equally honest about the bearish case, because ignoring it is how people get trapped. The first bearish argument is valuation relative to recent history. Silver has moved a long way in a short time. From the mid-20s to low 30s in a few months is not trivial. Even in bull markets, assets pause and retrace. The second bearish point is that much of the recent enthusiasm is narrative-driven rather than data-driven. When price action becomes the primary justification for higher price targets, risk increases. If momentum stalls, that same enthusiasm can evaporate quickly. Third, macro conditions are not unambiguously supportive. The dollar has stabilized rather than broken down. Yields remain elevated by historical standards. That limits how aggressively non-yielding assets can reprice in the short term. And fourth, silver has a long history of false starts. It is one of the most frustrating markets precisely because it invites big expectations and then fails to follow through more often than people remember. In the bearish scenario, silver fails to clear resistance, rolls over, and retraces toward the $29 to $30 zone, where longer-term support likely emerges. That scenario carries, in my view, about a 30% probability. That leaves the middle path, which is often the least discussed and most likely. In the middle case, silver does not collapse and does not explode. It churns. It trades between roughly $30 and $34 for several weeks, building energy, frustrating both sides, and letting indicators cool off. Eventually, a breakout or breakdown emerges from that range, but not on the dramatic timeline some are projecting. This is the outcome I think is most probable, with about a 45% likelihood. It's boring. It doesn't sell fear or euphoria. But markets spend most of their time being boring. To understand why this matters, it helps to look back at history, not to predict the future exactly, but to frame expectations realistically. In 2010, silver began a strong advance from the high teens into the mid-20s. At several points along that move, it looked like it was about to go vertical. Each time it paused, consolidated, and then resumed higher. The final blow-off phase didn't come until much later, after months of digestion. The similarity today is that silver is emerging from a long base with improving fundamentals. The difference is that monetary conditions are tighter now than they were then, and speculative appetite is more selective. That doesn't invalidate the bull case, but it tempers it. Another comparison people like to make is 2020. In that episode, silver collapsed briefly, then doubled in a matter of months. But that move was fueled by emergency monetary policy, zero rates, and massive stimulus. Today's environment is very different. History doesn't repeat, but it does rhyme. And right now, the rhyme suggests patience matters more than prediction. To round this out, we need to zoom out and look across markets, because silver does not trade in isolation. Gold has been steady, but not explosive. It's holding above key support, but struggling to make new highs. That suggests stability, not panic. The dollar index has stopped falling and is range-bound. That removes a tailwind, but it's not a headwind either. And the 10-year yield remains elevated but stable, which again points to balance rather than stress. Taken together, cross-market signals are mixed, not extreme. They don't scream breakout, and they don't scream collapse. They whisper consolidation. Before I wrap this part up, let's touch briefly on positioning. Commitment of traders. Data shows commercial hedgers increasing short exposure modestly as price has risen, which is normal. Speculators are more long, but not euphoric. Banks are behaving like risk managers, not prophets. All of this brings me to how I'm actually handling silver right now, which I'll walk through next in very concrete terms. What I own, what I'm not adding, where I would reduce, and what would force me to change my mind. Here's exactly how I'm thinking about silver right now, stripped of emotion and headlines. I currently have about 12% of my total portfolio allocated to silver and silver-related assets. Roughly half of that is physical metal, held with no intention of trading it in the short term. The other half is split between a low-cost silver ETF and a small position in a diversified miners basket. That allocation was built gradually between $24 and $29, not all at once. At current prices, around $32 to $33, I'm not adding. That's important. Not because I'm bearish, but because the risk-reward has shifted. When an asset moves quickly, the probability of short-term drawdowns increases, even if the longer-term trend remains intact. So here's my framework in plain language. If silver breaks above $34 on a daily close, and more importantly, holds that level for several sessions without immediately reversing, I do nothing. I let the position work. I don't chase it higher. I don't add leverage. I simply maintain exposure and let probabilities play out. If silver fails at that level and drifts back toward $30 in an orderly way, I'm open to adding a small amount, bringing total allocation up to around 14%. That would only happen if momentum resets and sentiment cools, not during a panic or a spike. If silver breaks below $29 on a weekly closing basis, I reduce exposure, not because the long-term story is broken, but because that would signal the market needs more time than I'm currently giving it. My soft stop is around $28.50. Below that, the opportunity cost increases. On the upside, I don't have a hard take profit level, but I do have a zone where I would start trimming. Between $38 and $40, assuming no fundamental regime change, I would likely reduce exposure by 2 to 3 percentage points, not exit entirely. That's about managing concentration, not calling a top. None of this is advice. It's just my framework, built around risk management rather than prediction. Equally important is what I'm not doing. I'm not panic buying because of thumbnails that imply urgency. Urgency is almost always a poor signal. I'm not consuming fear-driven or euphoria-driven content on repeat, because that distorts decision-making. And I'm not assuming that silver needs to save the system or that a collapse is imminent. Markets don't owe us drama. Instead, I'm focused on 3 very specific things this week. First, how silver behaves around the $33 to $34 zone. A strong close with follow-through is bullish. A sharp rejection with expanding volume is not. The difference matters. Second, I'm watching gold. If gold starts to break higher decisively while silver stalls, that's a warning sign. If gold holds steady and silver consolidates, that's healthy. If both break higher together, probabilities shift upward. Third, I'm watching the dollar and yields together. A falling dollar with stable yields is supportive. A rising dollar with rising yields is pressure. Mixed signals mean patience. At the end of the day, the next few days matter not because everything changes overnight, but because they help define the range of outcomes. Silver is at a decision point, not a destiny point. To summarize, silver is elevated but not extreme. Volatility is rising, but positioning is not euphoric. The bullish case is real but not dominant. The bearish case is plausible but not catastrophic. And the most likely outcome is consolidation that rewards discipline over excitement. If this kind of calm, probability-based analysis is useful to you, consider subscribing. That's what we do here at Financial Briefing. No hype, no fear, just frameworks. One more thing I want to emphasize, because it often gets lost when silver heats up, is how asymmetric this market can feel versus how it actually behaves. Silver has a reputation for explosive upside, and that reputation is earned, but it's incomplete. Those explosive phases tend to be short, late cycle, and emotionally exhausting. Most of the time, silver is a patience test. That's why I keep coming back to process. If you zoom out and look at silver's last 3 major advances, the majority of the gains were made by people who were already positioned before the headlines changed tone. Very few people bought the exact breakout and held through the volatility. Most either chased late or sold too early. Right now, sentiment is shifting, but it hasn't flipped. We're no longer in apathy, but we're not in mania either. That middle zone is where mistakes are easiest to make because confirmation bias starts creeping in. Every bullish data point feels decisive. Every bearish one feels temporary. This is also where time horizon matters. If your time horizon is measured in days, then yes, the next few sessions matter a lot. If your time horizon is measured in months or years, what matters more is whether silver can hold higher lows over time. One failed breakout does not negate a structural shift. One breakout does not guarantee a straight line higher. Another thing I'm watching, quietly but closely, is how silver reacts to good news versus bad news. Strong markets absorb bad news and still hold their levels. Weak markets fade good news quickly. Over the last few weeks, silver has absorbed several potentially negative inputs without breaking down. That's constructive. But it hasn't yet demonstrated the ability to accelerate on positive inputs either. That's the balance. I also want to address a common assumption floating around right now, which is that silver has to catch up. Catch-up trades exist, but they don't operate on fairness. They operate on flows. Silver doesn't move because it deserves to. It moves because capital decides it's the best place to go at a given moment. So when you hear that silver is undervalued relative to money supply or relative to gold or relative to history, treat that as background context, not a trigger. Valuation can tell you where not to sell. It cannot tell you when to buy aggressively. As we move through this week, I'll be paying attention not just to price, but to character. Is selling sharp or orderly? Are rallies impulsive or labored? Is volume confirming moves or fading? Those are the tells that don't show up in thumbnails. And if nothing happens, if silver just goes sideways, that is information too. Sideways. Action at elevated levels is how markets digest gains. It's how weak hands exit and strong hands build positions quietly. So if you're holding silver right now, the most important thing you can do is align your actions with your intent. If you bought silver as a long-term hedge or diversification tool, short-term noise should not force decisions. If you bought it as a trade, then you need predefined exits, both up and down. Confusion comes from mixing those two mindsets. I'll leave you with this thought. The biggest risk in markets is rarely being early or late. It's being emotionally reactive. Silver is giving us a moment that feels important because it is important, but importance does not mean urgency. Let the market show its hand. React to what it does, not what people say it will do. That's the lens I'll continue to use, and I'll keep sharing updates as the data changes. Thanks for spending your time here with me on Financial Briefing. One last layer I want to add, because this is where experienced silver holders tend to separate themselves from everyone else, is expectations around speed. Silver does not usually reward impatience. When it does move fast, it's almost always after a long period where it felt like nothing was happening. That's why so many people miss the bulk of the move. They get bored, distracted, or shaken out before the payoff phase ever arrives. Right now, silver is not boring. It's active, it's visible, and it's being talked about. That alone should tell you something. Markets tend to do their most dramatic work when attention is lowest, not highest. High attention phases are usually transition phases, where ownership changes hands. That doesn't mean this move is over. It means the easy part is likely behind us. From here, gains, if they come, will probably require more patience and more emotional control than the run-up did. Another subtle but important point is how silver behaves relative to equities. Over the last month, silver has moved higher even as equity markets have shown signs of fatigue. That decoupling is constructive from a diversification standpoint. It suggests silver is being treated, at least partially, as its own asset, rather than just a high beta risk trade. But again, this is nuance. It's not a signal to go all in. It's a signal to respect the role silver can play without overestimating it. I also want to address leverage, because this is where people tend to get hurt when silver gets exciting. Leverage products, options, and short-term futures trades amplify both outcomes and emotions. They require precision, discipline, and the willingness to be wrong quickly. Most people don't have all three at the same time. For most holders, unlevered exposure combined with patience outperforms cleverness. That's not exciting. It doesn't feel sophisticated. But over full cycles, it tends to work. As this week unfolds, I'm deliberately keeping my decision frequency low. I don't need to react to every intraday move. I don't need to interpret every candle. I need to see how the market closes, how it behaves over multiple sessions, and whether levels hold or fail with conviction. If silver breaks higher and holds, great. I'm already positioned. If it pulls back and consolidates, also fine. That creates opportunity. If it breaks lower, I reassess. None of those outcomes threaten my framework. That is the mindset I know Group D encourage you to adopt if you holding silver right now. Not confidence, not fear, flexibility. Because the truth is, the next few days could change everything, or they could change nothing at all, and both outcomes are perfectly normal. If you're holding silver, the next few days could change everything.